In our last lesson, we learned two very important words in accounting: assets and liabilities. But there was one piece of the puzzle we deliberately left out. And without that piece, the accounting equation isn't complete. So here is a question. If a business owns 5 lakh worth of assets and owes 2 lakh to others, who owns the remaining 3 lakh? Think about it. The answer is the owner, and that remaining amount is called owner's equity. Welcome back to Canvas Academy. In our last lesson, we learned what assets and liabilities are. Today, we are going to understand the third and final parts of the basic accounting equation, owner's equity. And don't worry, we are going to keep it just as simple as our last lesson. Imagine you decide to start a small business, let's say a little coffee shop. You put 3 lakh rupees of your money into the business. That money now belongs to the business. The business uses it to buy things, maybe coffee machines, tables, chairs, and some initial stock. So the business now has assets worth 3 lakh rupees. But here is the important question: where did that 3 lakh rupees come from? It came from you, the owner. When the owner puts their money into the business, the owner has a claim on that business. In accounting, we call that claim as owner's equity. So in our example, you put 3 lakh rupees into the business has 3 lakh of assets, and the owner's equity is 3 lakh rupees. Now let's make things a little more interesting. Your coffee shop needs another 2 lakh rupees, but you don't have that money. So you borrow 2 lakh from the bank. Now the business has 5 lakh of assets, but where did that 5 lakh came from? 3 lakh came from you, the owner, and the 2 lakh came from the bank. So the business owes 2 lakh to the bank. That's liability. And now everything falls in place. The business has 5 lakh in assets, it owes 2 lakhs in liability. So what belongs to the owner? 3 lakh rupees. That's the owner's equity. And this gives us the accounting equation: assets is equal to liabilities plus owner's equity. Now, I don't want you to memorize that equation just yet. Let's understand why it works. Think of everything a business owns as the business resources. Those resources have to come from somewhere, right? They can come from money borrowed from outsiders, that's liability, like our loan. Or they can come from the owner, that's owner's equity. So, everything the business owns has been financed by either outsiders or the owner. Imagine a 10 lakh rupees pie. That's a business total assets. Suppose 4 lakh was financed through loans, that's liabilities. What about the remaining 6 lakh? That is the owner's equity. So 10 lakh of assets equal 4 lakhs of liability plus 6 lakh of owner's equity. Here is something important. Owner's equity doesn't simply mean the cash the owner has put into the business. It represents the owner's overall claim on the business. So if the business makes a profit, the owner's equity can increase. If the business makes a loss, the owner's equity can decrease. And if the owner takes money or assets out of the business for personal use, the owner's equity can also decrease. Let's take a simple example. You start your business with 3 lakh rupees. So your owner's equity is 3 lakh. During the year, your business makes a profit of 50,000 rupees. That profit belongs to the owner. So, all else being equal, the owner's equity increases. 3 lakhs become 3 lakhs and 50,000 rupees. But imagine the business makes a loss of 50,000 instead. Now the owner's claim becomes smaller. So 3 lakhs becomes 2 lakh 50,000 rupees. That's why profit increases equity while a loss decreases equity. Suppose you take 20,000 rupees from the business to use personally. That money is no longer being used by the business. So the owner's equity decreases by 20,000 rupees. These withdrawals are called drawings. We will explore drawings in more detail in another lesson. For now, just remember money put into the business can increase the owner's claim. Money taken out for personal use can decreases it. Now we can look at the equation from another angle. If assets is equal to liabilities plus owner's equity, then owner's equity is equal to assets minus liabilities. So, if a business has 8 lakh of assets and 3 lakhs of liabilities, the owner's equity is 5 lakh. That's it. Remember our first lesson? We asked two simple questions. What do I own? And what do I owe? Now we can add one more question. What is the owner's claim? What I own gives us assets, what I owe gives us liabilities, and what remains for the owner is owner's equity. Let's make this really simple. Assets are what the business owns or controls that have value. Liabilities are what the business owes to outsiders. Owner's equity is the owner's claim on the business, and together they make the accounting equation assets is equal to liabilities plus owner's equity. One last example. Imagine a business has 10 lakh in assets and 6 lakh in liabilities. How much is the owner's equity? Think about it. 10 lakh minus 6 lakh gives us 4 lakh. So the owner's equity is 4 lakh rupees. And that's the missing piece of the accounting equation. You don't need to memorize it blindly anymore. Just remember the story. A business owns things. It owes money to outsiders. And the owner has a claim on what is left. That is owner's equity. If this lesson made the accounting equation a little clearer, you're already one step ahead. In our next lesson, we will start breaking down the individual parts of accounting even further. If you enjoyed learning this way, consider subscribing to Canvas Academy. Until next time, keep learning, stay curious, and I'll see you in the next lesson. Thank you for watching Canvas Academy.